start with, and we'll start with the Coverdell accounts. These used to be known as the Education IRA, which I will tell you I always felt was one of the most stupid terms ever created by Congress. It's not an IRA, but it was acting like an IRA. When it became Coverdell, it was beefed up significantly. And it's an interesting addition to education financing. So first of all, contributions are not tax deductible. Whatever you fund in here, you're not going to get an adjustment to gross income. The contribution limit is $2,000 per child per year, which is interesting because you might have a number of people who have said, I would like to fund this leave, such as parents, grandparents, et cetera, and it's limited to $2,000 per child. It cannot be made, contributions can't be made once the account holder reaches 18. So it's $2,000 a year, and if you do it right, 18 times 2 is 36,000. It can grow, obviously, but it's not going to reach the same levels as, say, a 529 plan. And so just be aware that this is it's a supplement, in my opinion, and you can make the payments here by the unextended due date of the return. So it does give you some tax season planning. You can advise a client as long as they're getting the return done timely without extension. The phase out has not been inflation adjusted, by the way. When you make too much money, and you can see what the modified AGI numbers are, you can't fund it. Doesn't mean that someone else in your family can't fund it. So that's actually kind of an interesting little add-on too. You would actually, if you want to put money in, you have to find the right family member who fits the AGI profile, which would be, are you under $190,000? If you're married, filing joint, $95,000 if you're single, and anyone else. The earnings are tax-free if used for qualified expenses, and the education level, Lee, is kindergarten and above. So you can pay for private school up through college, and then college and grad school. So it's an interesting addition, Lee.